We incurred a first quarter net loss that was in line with our expectations, driven by a $380 million pre-tax negative financial impact related to the December operational disruption. Roughly $325 million of that was from lower revenue in January and February, much of that cancellations of holiday return trips. We saw a strong rebound in revenue trends in March, resulting in record first quarter revenues despite the impact of the December disruption. Travel demand remains strong thus far, but we remain mindful of the uncertain economic environment. You have to be, given all the headlines and trends we are seeing across many industries. We have tough year-over-year revenue comparisons here in the second quarter, with last year's domestic revenue environment getting a boost from international closures. Taking that into consideration, demand, particularly leisure, continues to show strength as we head into the busy summer travel season. We are reducing our full year 2023 growth plans due to a lower planning assumption for Boeing MAX deliveries this year. This relates to the recent news of further supply chain challenges at Boeing. The outcome is a reduction to our 2023 capacity and CapEx outlook, and we are currently reevaluating our hiring needs relative to our most recent expectation to hire more than 7,000 net new employees this year. We will be moderating our overall hiring plans as we get into the second half of 2023. In the meantime, we are most focused on revisions to our second half 2023 flight schedules to account for fewer aircraft, which Andrew will cover in more detail. I'm very proud of the progress we are making on our customer experience enhancements. As a reminder, we are investing in 3 onboard initiatives: enhanced Wi-Fi, in-seat power, and larger overhead bins. In early March, our first new aircraft with hardware from our new Wi-Fi provider, Viasat, entered revenue service. By third quarter, we expect all of our existing aircraft to be flying with upgraded Wi-Fi and Nuvu hardware, offering increased speed and reliability. So just great progress on that front. Our new MAX 8 deliveries are coming into service with in-seat power and larger overhead bins, so those are already entering service as well. We're also very focused on mobile and other enhancements on our technology roadmap to offer more self-service options for our customers to give them more flexibility and ease during their journey. Highlighting one of our stronghold markets, Southwest is the #1 airline in Kansas City, growing from 6 flights in 1982 to 75 flights today, and I'm proud to say that our service in Kansas City is now fully restored to pre-pandemic levels. We recently celebrated the opening of the new Kansas City Airport in February, and we serve as the chair of the Airport and Airlines Affairs Committee. We really appreciated the opportunity to partner with the airport to deliver a beautiful new terminal that will serve us and the community well for a very long period of time. It was a great partnership all the way around, and it is a beautiful facility. We continue to work hard on labor agreements for our people, and we continue to make progress. We just reached a tentative agreement with TW 550, which represents our meteorologists, and I want to commend both negotiating committees for the spirit of cooperation that led to that agreement. We remain focused on negotiations with the union representing our ramp and ops employees and mediation with unions representing our pilots and flight attendants, and remain committed to competitive market compensation packages for our people. We are very eager to get new contracts and have a significant amount of wage rate increases that have already been accrued and set aside, and we look forward to rewarding those remaining groups soon.
I'll take a minute to expand on the commentary in our press release this morning and provide more color on our first quarter results and second quarter outlook. Our first quarter revenue trends remained steady and within expectations throughout the quarter, with first quarter revenue growth of 21.6% year over year. This was right at the midpoint of guidance going back to our January earnings call, and as a reminder, we had 2 competing storylines in first quarter that played out as we anticipated. First, we incurred an estimated $325 million negative revenue impact that was isolated to January and February. This was the result of cancellations for return holiday travel and a slowdown in bookings following our operational disruptions in late December. We believe these negative revenue impacts have subsided and are now behind us. We saw the reverse over the second half of the quarter and witnessed strong revenue trends throughout March. That showed up in terms of overall demand, rapid reward redemptions, and yields. And so even with the negative revenue impact at the beginning of the quarter, we had record first quarter operating revenues of $5.7 billion and record first quarter RASM of 15 cents. Managed business revenues also improved significantly throughout the quarter, and by March were nearly restored to March 2019 levels, just shy of 100%. That is tremendous progress, and it feels like we're very close to full corporate revenue recovery at Southwest. Our managed business revenues have trended ahead of the industry due to our revenue initiatives in the corporate space, and this is driving new corporate accounts, which of course opens up access to incremental new pools of corporate passengers. And while the managed business recovery still isn't consistent across traveler sector or size of accounts, we expect further sequential improvement in managed business revenues from first quarter to second quarter. How the demand comes in may be a bit choppy with more volumes further out in the booking curve, but this doesn't seem to be unique in the industry based on ARC data. Regardless, we expect to continue making market share gains in the managed business space as we gained another point of market share in first quarter, while we expect to grow passenger volume from our initiatives on very solid yields. In terms of the leisure booking curve, it has moved further out from what we saw last summer and fall and seems to have more or less normalized to pre-pandemic levels. Leisure demands and yields, which are well above pre-pandemic levels, continue to be strong heading into summer, and we're currently seeing the sequential improvements in operating revenue and yields that we would expect in the seasonally strong second quarter. All in all, the overall domestic revenue environment remains strong, and our initiatives are performing in line with our expectations. So in short, we're pleased with what we're currently seeing. And finally, our portfolio of new cities, including Hawaii, continue to mature. I'm also proud to announce that we have completed the selection and rollout of our new revenue management system, which is the Amadeus Network Revenue Management product. Our implementation timing is slightly ahead of our previous timeline of mid-2023, and we're very pleased with the revenue results we saw from Amadeus during the production pilot.
And the next question is from Scott Group from Wolfe Research. Please go ahead.
Hey, thanks. Afternoon. So, Andrew, I want to follow up on the capacity cuts. When you were talking through the point of capacity, you said maybe I misheard, but I thought you said a point out of Q3 and then like 6 points or something out of Q4. I didn't really understand it. And then more importantly, like, what does this mean for capacity next year? Is there now more growth next year to catch up? Is there less growth because we're just going to continue this? How do I think about that?
Well, I'll start off, and then Tammy and Bob can chime in. But the impact to the delivery book from the Boeing quality escape means that effectively it's the kind of fourth quarter where you'll be short the aircraft. And then for those schedules will bear the brunt. Probably from September through December, those schedules will be less than originally projected. So we will modify those schedules to make sure they reflect the lower aircraft count. September and October will be modest revisions to what was already published. We actually published those schedules with some easily movable aircraft to hedge our bets in case something did happen, so that'll be fairly clean. And then we were about to publish November, December. Now we're going to go back and redevelop November, December with a lower aircraft count to reflect this. And so that's what's going to drive the capacity lower during that period of time versus original plan. And then for next year, I think Bob touched on that when we talked about reflowing the order book, because these aircraft that were not delivered last year, not delivered this year, you can't just assume they're bunching up and they're all coming one slug next year, because that would be, we're looking for an orderly growth, as Bob said. So as we reflow that order book, then we can look to what that means for 24, 25.
Yeah, I think the other thing just to point out is, it may be related, is we talked a lot about what's constraining the airline, and right now that is pilot hiring. So we have aircraft effectively that we are not producing capacity out of today because the constraint is just pilots. A lot of carriers are dealing with this, and that was going to true up roughly at the end of the year. Now with the order book dropping, the deliveries this year dropping from 90 to 70, that's the point at which the pilot constraint turns into an aircraft constraint will definitely be earlier. It'll be post-summer, late third quarter, early fourth quarter, but we'll flip to aircraft constrained from pilot constrained. And we'll just take that into account as we think about hiring and planning for this year, and then planning again for next year. Because again, a lot of the hiring is planning for growth next year. So number one, the constraint will flip to aircraft constrained. And then second, we want, again, as Andrew said, we want orderly growth. We don't want 152 aircraft next year. We want to grow. We have a lot of opportunities, but we want that growth to be orderly and measured and as consistent as we can be year to year to year. So hopefully that helps with just thinking about capacity next year and how that relates to the order book. We have work to do with Boeing, obviously. The news is still pretty fresh, about 10 days or so old. We have work to do with Boeing to just think about how to reflow the order book here, and we'll get through that and keep you informed as we do that. I think the other thing
Thank you, guys.
The other thing I think I would add is just we are seeing, as Brian pointed out in his remarks, we're seeing strong business demand here. We were just right at restored to 2019 levels in March, which I think is a remarkable accomplishment and I think industry leading in terms of our ability to get there that quickly. It's going to be choppy a little bit here in the second quarter, but we do expect sequential improvement from the first quarter to the second quarter in terms of business bookings and managed business. And I'm just really proud of that. On top of that, you've got obviously the investments we've made in business, GDS, those are showing up. We've got, and Ryan can talk to this, we've made our selection around a new revenue management system with Amadeus. Actually made that selection earlier than we talked about at Investor Day. That system is now managing all forward bookings, all forward travel periods, and we expect a good revenue results from the system as well. So a lot of other positives that will come on here as you move forward across the year.
The next question is from Jamie Baker from J.P. Morgan. Please go ahead.
So from a passenger perspective, or let's say a new passenger, so somebody that's just starting to fly, they've reached that, economic level, or they're just, entering the workforce, whatever. Somebody that's not already loyal, what's the value proposition for flying Southwest these days? I mean, I get it in a point-to-point, for point-to-point operations, many instances where you're going to be up, your only competitors are connecting flights, so that's a no-brainer. But in truly competitive markets, if the price is equal and if a passenger isn't already wed to your brand or your, credit card ecosystem, what does Southwest do to attract that first-time buyer?
I think that the brand strengths that have been in place for almost for 52 years are still there. We have and even better, we have a tremendous network. Again, far more nonstop direct flights. We have terrific service, our on-time performance. All those things are improving as well. We're continuing to work on the customer experience. We have new deliveries are coming now with power on the aircraft. We have the larger overhead bins. We have improved Wi-Fi. We have our terrific employees in service. And, of course, we have really good, everyday, low fares. So those brand strengths have not changed. If you look at something like the larger overhead bins, and again, it's a small sample size. We have it on a relatively small number of aircraft at this point, but we're watching the data. It's reducing, Andrew checked me, but in what we've seen so far, it's reducing gate check bags by 60%. That's a huge win for our customers. It's a big win for us as well. It certainly helps with cost. It's again, a modest amount of data, but it's reducing turn times as well on our aircraft. But back to your question, I mean, the value proposition that has always existed for Southwest Airlines for over 50 years is still true today. When you look at, one of the things we look at constantly before the ops disruption and after is consideration. Where do we sit in the consideration set, both for customers of Southwest and customers that are for the first time considering Southwest Airlines? And those numbers are really strong. They dipped, of course, during the disruption, but they've come back quickly and tells me that we don't have a hangover from the ops disruption.
The next question is from Holden Willen from Dallas Business Journal. Please go ahead.
Hey, thanks for taking my question, guys. I believe it was at yesterday where you guys said that you'd added like more than 8,000 new corporate accounts last year. I'm just wondering, as you continue to see the managed business travel recovery in the first quarter, how many more accounts you were able to add during that period, and if you can point to any specific factors as to why you think managed business travel is continuing to recover for you guys. Thanks.
Yeah, I think largely the reason that managed business continues to recover for us is because of the initiatives that we have that we've put in place. I think if you look at managed business travel sitting here today and kind of where it sits structurally relative to kind of where it's been historically, there's a couple of things at play that have reduced managed travel kind of for the industry. The first of those is, health scares of traveling, and I think that is well behind us, and I think any tailwinds from that just are unrealistic at this point. And so then the other structural component that I think has kind of depressed managed business travel for the industry, not for us necessarily, but for the industry, is some of these, just the way consumers work today, their home versus office patterns versus remote, and some of the digital tools. And I think that kind of is what it is at this point. There may be marginal improvements in different parts of the country, but it's largely is what it is. And when you look at how that manifests itself is the unique number of travelers who are traveling in corporate travel are actually, it's restored to where it was kind of pre-pandemic. What's down is the frequency of those travelers. And that is largely, or I guess it's disproportionately impacts global and national accounts. And so we are after backfilling that volume by going out and acquiring new mid-market, small and medium business accounts, and opening up access to new pools of corporate travelers. And that's what we're seeing. I think in March, we had a record number of mid-market accounts active for us. I think if you look at April, we may have another record here in April. And so we're going to be after the market share gain. We're going out to win new accounts, open up access to new pools of travelers. We gained a point of market share in the managed travel space over the last quarter. And so that's where we'll be focused going forward, and that's where the sales team is focused, and our efforts seem to be paying off.
Well, we put a lot of emphasis on building the team over years now, adding technology like the GDS access, and it will pay off over time. I think, as Ryan said, I think that's the reason you've seen us nearly restore ourselves in March here to pre-pandemic, first airline to do that. And Ryan, check me, but I think we've had 9 of our 10 best managed business booking days in the last 2 weeks in our history.
Since April, yeah, in the month of April, yeah.
In the month of April. So we're just so you're seeing that strength is continuing, and I do think it's because of our investments and winning share.
And we're focused on continuing to remove friction and being easier to do business with in the managed travel space. And there's some trends, across the industry where others are making it harder to do business in the managed travel space. And so I think that, you couple all of this that we've just been talking about with our business-friendly network, business-friendly policies, industry-leading frequent flyer program, I like our chances going forward.